Hi, this is Vaibhav here. I'm one of the co-founders at ftCash.
It is no secret that there is no money in building a payments business because thanks to the UPI, there is virtually no commission to be made in the processing of payments. Payment startups like Paytm and Bharat Pay are taking the approach using their payments business to acquire customers for building a profitable lending business. Time will tell if their approach is the right one or not. But in the shadows of these large payment companies exists a startup that is building with a reverse philosophy. ftCash is a fintech startup that first acquires customers for loans and then gives them the payment processing services. In this episode of the Founder Thesis podcast, your host Akshay Dutt talks with Vaibhav Lodha, the co-founder of ftCash, about his journey of building a sustainable fintech startup. Vaibhav comes from the social impact space, and in this conversation he talks about how his unique background helped him build ftCash using first principles thinking. Stay tuned and subscribe to the Founder Thesis podcast on any audio streaming platform to learn about building and scaling your startup sustainably.
So it so happened that I was consistently still visiting, networking, meeting people. And Inc. is an organization that was launching an organization in India called X Prize at the time. And they were launching their first prize. So they just held like a pre-launch event for us. And I happened to be there. So Mr. Ratan Tata was there. His sister Xenia Tata was there. So I met both of them. And I wrote to Xenia later saying that you're doing amazing work. So X Prize is an organization. Actually, I'm not sure if you're aware of it, but it has one of the most fascinating stories of origin that I can imagine. It was also a dream job for me. So in 1995, Peter Diamandis, who is the founder of X Prize, launched a prize saying that the entire space industry is completely government owned, which is NASA. So I want to privatize it. So whoever launches the first spacecraft that launches from Earth, goes to suborbital space 100 kilometers above Earth, comes back, and within, I think, a span of 2 weeks, goes back again with a private space tourist, I'll give them $10 million.
And who is Peter Diamandis? How did he get this $10 million?
So he didn't have money at the time. In fact, he was working out of his garage at the time. So he found a sponsor during the course of the prize, when he launched the prize. So for nine years, nobody was able to solve it. In the 10th year, actually, there's a company that actually solved it. They went to space, they came back. They used the same aircraft to launch it again with the sponsor of the prize. I think the lady's name was Mrs. Anushe. She was also the first female space tourist ever. She's now the CEO of X Prize, by the way. And so when it landed in Mojave Desert at the time, right, Richard Branson actually bought it as Virgin Galactic at the time. So that is the origins of X Prize, Virgin Galactic, etc. So I was very fascinated by this organization. I was like, I have to be a part of it irrespective. So then I met Genia. Like, it was very...
I'm assuming that once this one prize was won and achieved, they would have continued to create new targets, prizes. Say the Nobel Prize, basically, it becomes an institution.
Yeah. So then this was an institution which was launching multiple prizes. So another prize that they launched was like to create a car that could drive, I think, 100 miles in 1 gallon. Right? They have one prize for education, one prize in ocean cleanup. So the prize that they had in mind for, and this was the first prize that they were launching outside of India. So I was basically, after my discussions with Xenia and the other team members, like I got invited to join as a global development for them to launch their prize in India. And that prize happened to be a water-related prize because of my experience now in water, having worked in multiple places. That can we create drinking water out of thin air? Because at that time, there was an article in Economist in 2012 or 13 saying that the next world war in 2025 is likely to happen because of water crisis. So they said, like, can we create an atmospheric water generator that can actually just draw atmospheric water and then convert that into drinking water as well? We launched the prize, and then like it was just the start of it. Like, we did a lot of research background, we created the guidelines, etc. around it as well. Though unfortunately, X Prize at the time in India had a relatively short stint because so X Prize was a non-profit, and for non-profits to launch prizes, they need to have funds, and funds require FCRA.
What is FCRA? Foreign Currency Regulatory Act.
Something of that order. So it requires 3 years of financial records to be able to get that itself. And I think because of the misuse of some of these organizations in the past having FCRA, there was also tightening of FCRA certificates in the years preceding. And I think in the recent years also has been very hard. So then they realized that to launch this prize, the prize money cannot be given itself, because all the donors wanted to give the prize to the Indian entity, and that would not happen without FCRA. So then we had to actually curtail that price. It launched in a very smaller format in the US itself, but then it didn't have the same fee. So at that same time, like I realized that, okay, unfortunately, I think my path in this organization might not go the same way I wanted to. So I was also trying to create a product in a different space, which is with a friend actually in a civic governance space, civic tech governance space. This was an organization. Now I think I find that name funny. We called it Citizen Kane. We were trying to say that, okay, can we create technologies and products to measure large corporations, government, non-profits to track the large projects better using tech? And I think those projects probably those ideas can be a lot more feasible today with the advent of, I think, drones and IoTs, etc., and the tech related to it. But at that time, I think it was a little more far-fetched than I think it was. And I was very naive as well. But I think what helped me was that one, understanding again that there's no product market fit, that users need to have a paying ability for every product. And in this case, what I was also trying to do was create a product to bring out corruption across organizations. And the people who were going to buy this product were also people who were corrupt. So it would not really happen at the same time. So what happened was, a lot of pilot projects. We were able to create a good team as well, a very elaborate team actually. But at the same time, it didn't take off. So that time is when I just happened to meet my co-founders. So Sanjeev, I met him at an Ivy League mixer at the time. And it just happened that he's been out in the US for the longest time, since 2007. He was working deputy CFO for Deutsche Bank at the time. And we started speaking about financial services. And then this idea came about, like small merchants and like why we don't have payment systems for them here. This is obviously like much before like some of these larger players had picked up as well. Quite got sunk in the idea as well. I realized that you're not going much with Citizen Kane anyway. So then we said that let's take this forward. Sanjeev, Deepak and I, then we got started with ftCash at the time. We left our respective jobs. And then this is what we got into full time as well. So that was 2015. Mid 2015 is when we got started with this.
So the problem you identified was that a credit card POS machine is present in very few merchants. More merchants need a way to accept digital payments. That was the problem you identified.
Yes. So we, having spent, like all of us has been outside, spent time outside India as well. Digital payment is a norm there than an exception, right? In India, that's not really the case. We said, how do we change that? As simple as that. Like, why is it that this is not a norm in India and how can we change that? So our initial survey said that the cost or the monthly rentals of POS machine was the determinant to it. And also banks didn't really have any reason to service like smaller merchants because the transaction volume would be so low that they'd hardly get anything. So we said, like, why don't we take that set of merchants, not like the big bazaars of the world, but the smaller retailers that actually have a need. And we don't need to create like a hardware POS because hardware has a cost. Can we create like an app-based payment system wherein from the app you're able to make a payment? We can create a link-based payment system. We can create a QR code where you can make a payment, which would eventually direct you to a link itself. That time, obviously, UPI was not existing as well. But so we created that entire spectrum. We also said that we keep it an open platform. That I think was an important decision for us because we said that any new payment method that comes in, be it like a wallet, be it like later on UPI, we will be accepting of that on a platform itself rather than becoming a closed garden. Because what was happening was all the extremely well-funded companies were moving towards a wallet direction, that we'll have a closed wallet of our own and we'll only want transactions within that. Our thesis at that time was that, then this becomes a winner-take-all market. I don't know if it'll ever become a winner-take-all market because usually it's never been across the world. Even in the world, MasterCard and Visa are two players and Amex is a third player. So we didn't believe in that setting that, okay, only one wallet will become the biggest one. But we were facing a lot of heat from merchants because what was happening was all these companies had so much money that even if we gave a POS machine or like a payment system at a much lower cost than even what we are incurring, right? They're like, इस पे cashback कौन देगा? या इस पे मैं transaction करूंगा तो आप कस्टमर को discount दो. And was weird to us. I was like, this is a service. And if you, instead of paying for a service, we're anyway giving it to you at a discount. We're not even charging you fixed fee, but you're asking us to pay on every transaction, which doesn't sound, but I think that was a froth at the time as well. But
So-
we didn't believe, sorry, go on.
This is, you're talking about Paytm, MobiKwik. These were the wallet companies at that time who had like a closed garden approach that you need
Yeah.
to have the Paytm app and load the Paytm app to pay via Paytm to a merchant, similar from MobiKwik.
Correct.
So what you wanted was something which is more through the existing credit card or debit cards that people are carrying. Just give them a way to swipe
Or-
that card.
Yeah, we included Paytm and MobiKwik and all these other wallets also in our system.
Okay. And how did it work? Like how, if I have a debit card and I go to, let's say, a sari shop and I buy a sari and then
So if the merchant accepted ftCash, right? So they'd have the ftCash registration already done. So we would have taken their bank details, right? So whatever bank details that they would have, right? So if a customer now could either use a link or a QR or the ftCash app itself, they could search merchant or they could just do a QR scan of the merchant as well. Now, when they find the merchant, they can just put in either their credit card details, wallet details, made later on UPI details as well, just to make a payment, right? And the money would get credited into their bank account. So you're not creating a new infrastructure to say that, okay, you have this hindrance that we park this money in a separate ftCash wallet. No. We're saying whatever your bank account is, we'll put the money in there. And merchants also, we felt that they were far more comfortable with that.
So this would still need a lot of things which may not have been in place at that time. Say reliable internet. The merchant would also need internet to make sure that the payment has come in. Entering your Visa card into the app would have been a little painful, and then two-factor authentication. As compared to a POS, which it's so much faster.
Yeah. So all the issues you mentioned were absolutely the problem that we were trying to recover with as well. So one thing that we solved the problem for was the merchants actually having a smartphone and internet connection both, which is not prominent at the time. So we said a merchant can have a 2G phone also. All they will get is an SMS from ftCash confirming that the payment has been done. Because we already have the bank details, etc. So either the customer can use the app, they can use the QR, or they can use the payment link, which is fine. So that actually worked fairly well because that didn't require a merchant to have anything. Usually the merchants were the ones who had a 2G phone, not the customers. But yes, one party did need to have a smartphone, which was the customers in this case. But I think, like you said, the entering of the card details was a hindrance here. But there was no solution to that because NFC did not pick up that time and maybe till date as well. And that has been like the hindrance that we were banking on, that maybe if NFC picks up at a time, we may be able to include that in our payment. Or maybe we should be able to.
What does NFC do? How does it enable this friction getting removed?
So what would happen is if it picks up, you could have two mobile apps, both ftCash apps included. And if the NFC is on, you can just punch in the amount and then tap the two phones or tap the QR code and the payment is done.
Okay.
Okay. So then you didn't need to go through the entire spiel of like entering card details, etc. as well. We were quite excited about it as well. Unfortunately, that was not the case at the time.
Your revenue would have been through the MDR, the merchant discount rate, about 1.5% to 2%.
Correct. So that was what we were charging any merchant. So in this case, what happened was we realized that a lot of offline merchants were signing up, but they were not very consistent. They were only using it for deliveries, etc. as well. Like a grocery shop delivering it to a building would typically make a payment through ftCash, but it didn't have a very strong in-person resemblance to transactions. So what we started doing was we started focusing mostly on remote payments. So for example, travel agents, car service centers, they became our go-to across India. Like we were across all Mercedes showrooms. For example, we were there across so many Bombay showrooms that from a Maruti to a Ferrari showroom, we were there as well in as a payment method. So that really started putting us up on the map because a lot of big players who had these cars, right, were also using this method and they're like, this is cool. So this required zero marketing, but then they found that at least there is some convenience there, right? Our transaction numbers may have still been relatively low to what others were doing, but at least they were still at some point profitable. In some cases there was a product market fit in that case as well. And then obviously we were the first players to include UPI in offline setup along with ICICI Bank. So this was the launch of UPI. So we actually wrinkled out the entire system of UPI along with ICICI Bank for their launch as well. And we launched together. So this was, I think, August to September 2016. And a couple of months later, or like in November 8th, suddenly we see that demonetization happens, right? And that was a massive hit because we were extremely happy about that as a payments company, because there was a huge uptick of merchants. Typically, sales would find too hard to find 3 or 4 merchants to sign up in a day, but now able to sign up 20-30 merchants in a day as well, seamlessly. And like the demand was huge, the transactions are going through amazingly well. So much so that at some point we felt like our systems might break down just because the amount of transaction volume is so high. So that volume increase, we also were able to customize the product to whatever needs that were coming by. All of that was happening, but there was
one or two quick questions here first.
Yes.
Your way of onboarding merchants was through Salesforce, like you would have.
We had Feet on Street. We had an auto sign up as well, which you could do on website. But typically that would require a lot of marketing on our behalf, which we didn't have that kind of money for. So we raised only a small round from IB Cap Ventures at the time. We could not put like big billboards or TV advertisements. So typically Feet on Street was the way to go for us.
And you had Feet on Street pan India, or did you have a geographical focus?
We initially started from Powai. We expanded to Bombay. And then over a period of time, we went through the entire country.
Like by the time demonetization hit, what was your coverage? Like probably.
So we were there in most of the metros. But what happened was we also ended up having like indirect coverage through connectors. So these connectors would basically do on a success fee based model, who would be able to sign up merchants for us across the country.
What is a connector? Like,
so connectors are like channel partners who would say that, okay, for every successful sign up, you give me like 50 rupees or 60 rupees, and I'll get these merchant documents, KYC, whatever is required to sign up this merchant for you so that you can start accepting the payment system.
This would say a distributor who's connected to retailers. So
Correct. Okay. So they could say that, okay, yeah, I anyway have 1,000 merchants working with me. I don't mind earning like a 50,000 rupee commission if I sign up all these merchants. So they would do that. That was seamless for us as well because we didn't need physical presence. And typically what happens is that if we get through that one channel, then word of mouth will also spread and like more merchants will sign up in that space as well.
You must have incurred some payment gateway cost of your own. What was your net margin?
Actually, the net margin at that time was very poor. We were actually in MDR negative at the time. So what was happening was because we were relatively small, right? So the cost to us that companies were giving was actually very high. Say, for example, 1.7 or 1.8 for a credit card, right? But what the merchants would expect from us would be that, somebody else itself is giving me 1.7, 1.8. So if you give me 1.5, I'll take it, right? So they will haggle for the 10, 15 basis points or 20 points as well. And we felt that, okay, maybe we get started because we anyway not giving these cashbacks and discounts that we wanted. So we can take the hit right now, but as we scale, once we have volumes, we'll be able to get these rates down and also increase it for these merchants when they actually realize the value of these services. So yeah, that was the model that we went.
You went with a standard flat pricing, take it or leave it, or was there like some negotiation with each merchant? And
I think with larger merchants, there was some amount of negotiation, but with smaller merchants, there was no negotiation. We didn't have the time also. Like with larger merchants who committed to a certain amount of volume, yes,
like say Mercedes would have.
Yeah, like if a big showroom or somebody is saying that, yes, I'm going to give all car services to you and my volume would be like 5 crores a month, then yes, of course, we have like that discussion.
Okay. And what did you think, like eventually you would monetize as? Because this means essentially every transaction you are burning money. Like
we were burning money at the time for every transaction, but the idea was that like these 1.7 or 1.8 rates will also come to 1.3, 1.4, which is what others will get.
Like at scale, those your costs would come down. Okay.
Would come down because if you're doing smaller numbers, obviously no one's going to give you the best rates as well, because you have to become meaningful enough for a player to respect you. And at the same time, then when the customers are so hooked onto the system that they're deeply integrated with you, when you slowly and gradually increase the prices also, then they'll not mind, because then they'll see that I have to pay 20 basis points extra, but I know the value of the system and I'm okay to pay for it.
So this offering was a pure SME offering, like a simple app where you know how much you received, or you can generate a link with a prefixed amount. Was what describe the product to me? What's a person? And this would be like a free, and like there was no cost which a merchant had to bear to onboard. Onboarding would be free.
So there was no fixed cost for it. You could send out links as well, like you just said, with a pre-filled amount, so that you can just click and then choose a payment method of your choice. You could also just send an invoice to another merchant's customer's app also, or their phone on WhatsApp or SMS also. So all the optionalities were there. So what we'd done was customized in such a way that whatever is convenient. So we had also given some of the car service centers an entire SaaS system where they could just type in the phone number and the amount and then send it as a link also. Right? So the customized link would go. The same would be for travel agents as well. So
that link would be triggered through you, like you were sending out these SMSs.
We were sending out these SMSs for payment links, but like the data would obviously be input by the respective merchant as well. We realized that getting customers to download an app was a much more expensive process, even than that. And I think it's only got more expensive over the period of time because customers don't always want an app which they're not regularly using as well. So we realized links or QR codes was a much better and faster option to do it.
So the link would open a web page with a checkout where they could feed in there. So customer could save his card or he had to punch in the card each time?
They could save in the card. Once you enter your mobile number, you get the OTP to use the saved cards as well. So we were PCI DSS certified, so that was not an issue to save card details.
What is this PCI DS certified?
It basically is to say that, okay, you are certified by Payments Corporation to say that you can store card details and you can run payment transactions and the entire process is secure.
Okay. Got it. Okay. So now let's come back to demonetization. So demonetization hit, your sales team became super efficient. They were getting 10x the regular number of onboardings.
Yeah, but I think there was something more that was happening under the layers that we saw it only over the period of time that was happening. That these merchants, a lot of merchants were signing voluntarily as well. And they were doing transactions. They were learning the entire process by themselves. But slowly and gradually, they started moving away. Like the moment cash came back, their volumes dropped. Some of them completely dropped away. That was a question for us that if there's a movement as big as this, right, which can't move these merchants completely to digital payments, is there a real product market fit? And that's why I said like this theme of product market fit kept coming back to me again and again. So we had to reassess ourselves, our work also again, that is this a real merchant need?
During your peak, demonetization would have been the peak, right? So at that peak, what was your GTV, gross transaction value?
We were doing roughly about upwards of 60 crores a month, 70 crores a month approximately at the time. I think for a company that was 1.5 years old at the time, it was fairly good volumes. But obviously that took a hit to post that. So what happened was slowly when these merchants started receding, right? Not that our volumes dropped, but the rate of increase of these merchants dropped. The activity levels of these merchants dropped. And that was the number that we had to see that, okay, are we solving the right problem? And then we had to go back to first principles to understand from these merchants that what is making you drop out? Why cash or why this? Did you not find this convenient or what is really going on? And I think we learned a few things from them that payments is a nice tool for merchants to have, but it's actually pushed by customers. It's not their choice. So if given a choice, they would actually choose cash. Right? I would say that UPI has changed that a lot because of the ubiquity and the scale, but that was not the case at the time. But at the same time, they also felt that the transaction fee that they had to pay, etc., was not something that they were willing to pay, and they wanted to negotiate, etc., as well. Now, then we started asking them questions that, okay, what are your problems, right? Now, this is where we also went in deep understanding, okay, is lending, insurance, wealth management, all these questions, right? We asked them whether actually if we give you loans, will you take it from us? They said, no, loan to nahi chahiye aapse, matlab payments bank se mil jayega, whatever, right? But something told us that actually loans may be required and they just don't know that they require loans. Maybe among the set of merchants that we're targeting, maybe they don't require loans. So maybe we should widen our scope. Maybe we should launch a product, right, around it. So I think that was a gut-based decision, partially not so backed by data, but we still had to take a call. So we took a call. We started working on various lending products at that time. Now, we had to continue the payments business, but also go into lending, right? Now, we did that with partners to begin with. So we launched multiple products of different ticket sizes, different tenors, interest rates, etc. So a product could be as small as 10,000 to 1 lakh to 5 lakh also. And tenor could be like 1 week to 1 month to 6 months to a 12-month period also. So we had to figure out what is meaningful for these merchants, what works, what doesn't work. At the same time, also understand from the industry that in the current set of merchants or businesses that are already operating in this space, what is making them not so efficient that they would come to us? That actually did happen because we worked with a lot of partners at the time. We also understand the deficiencies that they had to be able to fill those. They allowed us to understand that, for example, post disbursal risk management was a big gap, right? Most of the partners in this space, what they were doing was, their story was that we have the best credit algorithm to assess these merchants. We have these thousands of data points and we do the best credit assessment. Now, what happens is, imagine a cycle of a loan, right? Imagine if I had to offer you a loan for 5 lakh rupees. You are worthy of it, right? And I'm able to assess that. Great. But if you have, and that assessment is only as good as 3 months. Going or 3 months later, right? If you end up having any emergency or like you have an intent issue or you just choose to run away, I can't do anything about it. That is not a part of the credit cycle I can work with. So we realized that post disbursal risk assessment or management is one of the most important parts that a lot of these players were missing. We had to fix that. And that was one very important piece that we started to work on as well. And we were trying to figure out how can we create that differentiation as well.
And why did that matter to you? So you would earn per loan sourced, right? I'm assuming that companies would pay you an origination fees. If you originate a loan, you get paid.
We signed up deals with them where we do the credit assessment and collections as well. So we said that we're going to take the risk on these loans because otherwise we don't have skin on the game. There's no point. And then they'll only give us like a brokerage type model, which is not what we wanted. Like at scale, if we really want to excel at this game, right? You can't be doing like a channel partner type model. Yeah, like a DSA. That probably would not be the most effective way for us to scale. So we did these partnerships with the intent that, okay, we will do these things. What will be the legal process that we'll follow? That will be a learning for us as well. So in the first, we launched a lot of these products, like at different tenors and ticket sizes. At the end of 1 year, we started to realize what is more meaningful for the merchant, what are the gaps in this segment, and what can we do to uniquely fill this gap as well.
How were you collecting? Was it like because you are a payment gateway, so you can deduct something every time they receive a payment? Was it like that?
Correct. So that's exactly what we did. And in fact, that was what I was come to as well, that we realized that with these merchants, our unique proposition can be that instead of them having a monthly EMI, right, they're not salaried employees. They don't get salary once a month. They're getting payments on a daily basis. Why not collect on a daily basis itself? So our payment systems would be given with every loan. And we tell that you repay these loans based on the payment system or daily basis from a payment system itself. The product that we eventually did launch, and that's something that we've been scaling for the last 5 years, right, is that these are loans in the ticket sizes of 1 to 25 lakhs because we realized actually 25 lakhs is an aberration. Typically, most of these loans, I would say 80% of these loans would be in the ticket size of 1 to 10 lakhs with an average size of 5.5 lakhs. That felt is a meaningful amount, but you're not overexposing the merchant to credit also because credit is debt trap is also a big deal. Like you can very into that. At the same time, we kept the interest rates in the market rate itself. People were charging roughly anywhere from 28 to 30%, 32%. We were charging the same. And we felt that in terms of tenor, anywhere from 12 to 24 months with an average of 18 months is what was meaningful for them. So we kept that also as 18 months. Now, when we did the repayment also from the payment system, that has suddenly, one, obviously helped with the post-disbursal risk management. But these three things also made sure that we got the right set of merchants that we wanted to work with. Then we started like this exclusive product itself, we started scaling this. We got to some amount of volume, not enough. And then we started going out in the market to raise funds around that. Luckily, over the course of next 1.5 years, we got 3 investors to back us.
When is this? When did you go out to raise more funds?
So we started, I think we've been raising funds forever, but exclusively we started going out in 2018 when we completely pivoted from just being a payments platform to say now we're a lending first company. And at the start of 2018, when we became a lending first company, that's when we said that now we will go out in the market. So it took us about 1.5 years at the time as well to show that when we're serious about it, we can do it well. And we have some track record to show that we can do it well. So in 2019 is when we got the funds from FMO, Axion and Ivy Cap Ventures, which is a Series A at the time.
Just about $7 million.
Yes, this is $7 million.
Okay. Like going back a little bit, what was your way to do underwriting? And you you did not have that in-house capability. How did you build that up? And were you doing collections through deductions from transactions right from the beginning, or did that evolve?
So the transaction deduction we were doing from the beginning in terms of collection, that we said is a very straightforward model for us. That will not take time because we already had a payment system inbuilt. We built a collection team on top of that. Right? That started with one person, and now today, like, it's a much larger team. But yes, at that time,
why do you need a collections team? Because you don't need to call and tell people to pay, right? It just happens automatically.
What happens is you always have these merchants who either need a physical visit after a point or require like a little bit of nudge. Because see, a lot of these merchants, right, they have good intent to pay, they're probably not getting. But there is always this 5% in the market that probably require that nudge and push. So you're working for those 5%, not the 95%.
No, but nudge to do what? Because you are... there's no manual input needed from the merchant, right? Every time he gets paid, you take a cut.
Yes, but what if they stopped using the payment system itself?
Okay. So in that case, you would ask them to do a back transfer. If they
could do. We typically have NACH and checks for these guys as well as a safety measure. We could put in the NACH as well, but you still require a team member in collections to say that, okay, what if the NACH doesn't work? Right? Then you have to physically visit, because in some of these cases, because we have daily payments, we've also seen stories where typically what would happen is, imagine your due date is 1st of November. So if your EMI fails on that day, then somebody would visit you only a week or 10 days later saying that, okay, why have you not paid? In our case, what happens is if the disbursal has happened on 1st of October, 1st October itself, we'll start having like deductions. If deductions don't happen, then we'll have call, then physical visits as well. So imagine if somebody has not made a payment for 7 straight days. So 3rd day, call will go, 5th day, we'll put nudge, 7th day, a physical visit will happen. So by 7th October, we are actually at their door. Right? So in this case, we were actually at somebody's door on 7th October in Hyderabad to see that they were winding their shop. And we figured that they were winding their shop, and basically they were trying to gather money through multiple loans and run away. At least we were the first ones on the door. So we were able to get our principal back. Right? For any bank or NBFC which had lent and they went on 1st of November, right? They got nothing out of it. Because what we have seen is also like no merchant or no business goes down in one day. They take some time to wrap up to go. You'll start seeing from the stock in the shop itself that yes, it's not deteriorating, etc. So with this frequency of transaction, you're able to make out a lot more than a typical EMI product.
Okay. So the way repayment happens is ideally through transactions, there is a daily deduction, and that daily deduction is automatically adjusted so that it meets the EMI for that month. Like, for example, if by the 20th, enough deductions have happened to meet the EMI, then 20th to 30th, there'll be no more deductions.
So what we do is I'll give you an example here. Imagine there's a 1 lakh rupee loan that is taken and the person has to pay 1,20,000 in the year, including the interest rate. Now, the approximate EMI for EDI, equated daily installment, comes to roughly about 368 in this case. So now what we will do is that in case if a customer has made a transaction of 1,000 rupees, we'll deduct the 368 rupees and transfer the remaining amount to their bank account. But we'll not take an extra amount from that day just because we have that. We'll say we'll cut only this much. But yes, in case if they've not done transactions or if they've only been 100 rupee transaction for 3 days, right? Then we'll say that okay, DPD is 1 now because your 300 rupees is pending. So let's try and make a...
Okay. What is DPD?
DPD is days past due.
Okay, days
past due. That how many days are you past the last due?
Yeah. Okay. And okay, so it's basically on a daily basis, and you would not tolerate more than 7 days of non-payment. If for 7 days continuously you've not been getting that daily installment, then you would escalate and try and
call them after the 3rd day.
But like, when would you use the NACH or the check?
So 3rd day is when the first call goes. We do consecutive calls on the 3rd and 4th day. In case on the 5th day also they're not responding, then we do the NACH and check that day. NACH or check, whichever one. And we get the result of the NACH or check next day. On the 7th day, if the NACS or check has failed, then we actually go physically visit them on BPD 7 also.
Okay. What if it's just because, let's say, he's gone to his village because it's a festival season? And
Fine. So as long as we've got a positive feedback saying that, okay, the merchant has just gone home or is just facing some health crisis, etc., then we're understanding. And then we say, okay, we'll come back a week later or whenever the merchant is back and we'll take the dues then. So just to understand whether the intent is there or not, the merchant is skipped or not, or if the business is going down or not.
got it. Okay. And what is your arrangement with NBFCs? Are you like co-lending where some of the loan is from your books and some is from their books, or are they lending to you and then you're lending it further ahead? Or like, how is that structured? Help me understand that.
Sure. Our NBFC license has recently come. In fact, it came in only April and we started using the license only since September. So it's only been a couple of months since lending on our books. We raised some capital on their NBFC as well as a debt. So there is some amount of loans that we're directly doing from our NBFC, but that is start, right? But we've had 5 years of history before that as well, where what we do is we work with partners on this model where we give them some security, saying that, okay, we'll take care of these loans. And typically they'd be okay to then say that, okay, we co-decide on a policy. And between that policy, the cases and files should come. And then on those, the acquisition of those merchants, the credit assessment of those merchants, and collections on those merchants is done by us. The disbursal is done by the partner. They do a credit analysis from their end as well to make sure that everything is kosher and like what we're saying is actually what we're doing. But apart from that, like the process is being run by us. That allows us to have a lot better control of these merchants as well. We're able to make sure that they're a lot more secure as well. And that's something that has helped us scale as well a lot. So in fact, that is one reason why we've realized, because of our post disbursal risk management, our NPAs in this space is actually one of the lowest in the industry. It's about 3.4, 3.5%, which is quite good for this segment.
Got it. Okay. Essentially, you'd be giving them like an FLDG, a first loss default guarantee, in exchange for a better take rate.
Yes, I wouldn't call that anymore because I think there are some norms around it in the recent times. But I think there is some amount of comfort that is given to any of these partners as well that eventually gets there. But yes, earlier we used to give FLDGs.
Okay. And what would be your take rate? 28 to 32% is what you were charging the customer.
Yeah.
So what was your...
So we earn about 8 to 9% on every loan, effectively. To see that, like our acquisition cost would be somewhere about 4%. Even if I take a risk at a higher number of about 6%, which is the maximum, like even during COVID, we only had a risk about 7.5%. So in extreme scenarios also, like in a regular business to business scenario, we assume 6%. Apart from that, credit, ops, everything included, and the cost of credit, we earn about 8 to 9% on every loan.
Okay. Amazing. Okay. So the NBFC partner would be charging about 10% and another 10% would be your cost of...
It's higher. The cost of capital these days is anywhere from 13 to 15%.
Okay.
Yeah.
Got it. Okay.
So that is a broad benchmark here. Yeah. We've typically not started working with banks yet because I think banks are still not completely catering to the segment as much.
You said your customer acquisition cost is 4%. Why do you have that cost? Or what is that? That cost is the cost of the burn you incur on the payment? Because payment is a loss leader, right?
No, so that has changed now. So in fact, like I was coming up to it. So what has changed now, right, is that when we pivoted to a lending first model. Now we said that our customers only who want a loan. We will not give a payments product just to anybody. We will not just get paid customers. If you want a loan, you work with us. And when we give you a loan, we give you a product also. Right? Now what happened was the cost of acquisition for payments became zero. And in fact, when you're giving a loan, nobody haggles on the pricing also for a payment anymore. So now when we say it, they're happy to take 1 point. Well, so in fact, payment has become a profit center for us now.
Okay. Got it.
And we realized like this switch was one of the most important things, and that's why having what the merchants want and listening to them was one of the most important parts for us.
Okay. But API would still be like zero earning, right? UPI doesn't have any MPR, but credit debit card.
At a blended level, it's still positive.
Amazing. Okay. Essentially, now you're a lending business at the core, and the payment is just something which helps you be more effective at lending, like in terms of high velocity collections and early warning signal. It gives you more data to give you a better portfolio, keep your NPS down.
Yeah, absolutely. Because I think our business, we realize, is also a collections business. It's not just a credit assessment business. It's not only like a distribution business, because distribution, in my opinion, is not even a problem. There are enough customers out there who want loans. It's actually a problem of how do you collect the money back from these guys. So if you're able to devise strategies around that, that solves your problem.
How do you do underwriting at the time of giving the loan? Is it based on the credit bureau score?
So bureau is one part of it. But apart from that, there's a host of data points that we look at as well, from their banking to their transaction data, a little bit of mobile data that is permissible as well. All that combined goes into an algorithm that throws up a number as to how much loan the merchant is eligible for how long. And then there is a manual overlay also on top of that. So we don't only do entirely digital. We do manual because we feel that the ticket size is large enough that it requires some physical intervention. And that also helps make sure that like the merchant is not cooped up. Like in India, you'll find all sorts of jugaad to figure out. Like people have made like a business out of it. So we want to make sure that we're able to catch these guys. So for example, we have an FC, which is a third party check also that is done.
FC, what is FC?
US fraud control unit.
Of fraud control. Okay.
Yeah. So which is a third party check, which enables you to go and check whether the customer actually exists or not, their shop is real or not, their house is real or not, etc.
Can you help me understand what is the, like for someone who doesn't know what is credit underwriting, how do you do credit underwriting? The simplistic way is to say, okay, if the credit bureau score is more than 650, then we will give a loan. But you're not doing that. Yeah. You're doing a lot of other analysis to form the decision. What is the way to think about how to do credit underwriting? What are some of those insights over there?
I think that's a great question to say that what are the ways to think about it, to say that, okay, how do you decide that number? Because you'll give a loan above a certain number. That is fine. But I think the art is to figure out how much amount for how long. The art lies in the fact that you can't have the person being given more money than they're actually able to earn to be able to repay their loans. So if their income, just making a number here, but if it's 50,000, that's say profit per month. Now you can't give a loan that in 18-month period without 20,000 rupee EMI also they're not able to pay back. Because if you give them an EMI which is 1 lakh rupees, 12 lakh rupee loan, they'll never be able to pay that back. So that is a number that you have to figure out. Obviously, you have to then be able to check whether their business volumes have been increasing over a period of time or not. What is the vintage of the business? Apart from that, you end up checking like how long have they been around in the house, the area, etc. as well. What the business line are they in right now? Is that at risk at any given moment right now? For example, post-COVID, restaurants were a big risk as a business, right? So at that moment, we were not doing restaurants, but now again, so now we can do it. So I think those signals also we have to check and keep evaluating that on an ongoing basis. You'll also realize that in certain cities, there are certain areas that are high risk compared to some other areas. Or there could be certain patterns that you start to observe between people itself, that the kind of fraud they're doing. So how do you catch those frauds? At what point do you start thinking somebody might be going to a debt trap? Like one insight I can tell you that we realized from a data science team, that if you have given somebody 3 top-ups, right? So first, second loan, and the third loan on top of that. After the third top-up, which is all the 18 months each, right? The risk on the merchant in the fourth top-up actually increases substantially, which is counterintuitive. You would have thought that if somebody has taken 3 consecutive loans from you, paid them back, right? They're actually able to do it. But what happens is everyone thinks that, and then they start over leveraging the merchant also. They start giving them the more amount than they actually need. And when merchant is indebted more than they can pay back, they only keep paying you interest, but they can't pay you the principal back. And that's when some of these go down as well. So you have to then at those points check whether the merchant is over leveraged, whether they're falling in a debt trap or not.
Okay. How do you calculate earning potential? That seems like the key to decide, right? Like how much money to give for duration, what duration. It depends on their earning potential or
So
their earning trend.
each industry has a certain benchmark margins that are there. We're able to then assess like from the revenues that they're earning as well, like what is that earning potential that is coming in. So that is one indicator into the entire base. Obviously, you'll also include that fact that if there's a grocery shop, right? Their sales are maybe say about 5 lakh rupees a month, and 50,000 is their margin because it's a 10% margin business, for example. Now, if you give them 2 additional lakh, right, then they will be able to make on those 2 lakh, maybe 10% additional every month, because you're adding to working capital as well. So with that, like, how are they able to pay you back the money? So then you can add those things as well.
Okay. Got it. Okay. Yeah. Now, so we crossed demonetization. We crossed your first fundraise of $7 million. So we are pretty much at where the pandemic would have hit. Tell me that part of the journey.
So I think when the pandemic hit, thankfully we just raised funds a year before that, 9 months before that. We were growing exceptionally at the time. Actually, we had grown 9x in that period, in those 9 months, and we were actually on the top of the world. And that suddenly put brakes on our growth at that moment, because one, lending obviously became a risky business that time, because if you give out loans but you don't know how the pandemic is going to last, how long, what business is going to be impacted the most, how long the lockdown is going to last, which cities the lockdown is going to be lasting, because we were also a lot more focused on Bombay at the time, and Bombay also had the longest one that happened. So Bombay opened 4th of November 2020 compared to some other cities that opened in May or June itself. So I think those existed. So we had that as an impact. So for a couple of months, our lending almost came down to literally zero. There was some amounts we had done, but not so much. And then from June 2020, we started disbursing again. We went into new cities, then we started disbursing there. And then we started picking up. So we had to almost start from ground zero and then pick it up to the numbers we are at today. Since then, I think even in wave 2 of lockdown, we didn't stop, because wave 2 also happened in different cities at different times. So obviously we were able to manage that. And we had also learned a lot from wave 1. So we were able to make sure that our business doesn't get impacted. So we have contingencies in place at the time. We had one of the decisions, I think, at the hardest at the time that we came across during COVID was a lot of companies were cutting salaries. And that was a no. You either letting go of people or cutting salaries. We felt very strongly that one, our employees have done nothing wrong. They don't deserve to cut their salaries, because it's not that they would not referring to work. So at that time, actually, we never cut salaries. We never delayed salaries at the time. That was one important decision that we took. And second thing that we also continued at the time was that apart from the low performing folks, which were continuing to be which is always the case, we never let any employees go as well. There was zero attrition, which was forced from our end at that time. And that, I think, has also stayed as an ethos with the company as well across employees, that we want to treat people fairly. And I think that is something that we continue to maintain today.
Okay. So you said June 2020, you went into new cities. Does that mean you hired feet on street in those cities? Like that's your way to acquire merchants, right? Like through feet on street.
Yep. Models in lending that we use to acquire merchants. One model is that we use feet on street, which is like approximately 30% of our business now. 40% of our business comes from connectors. Right? These are individuals who are like certain leads that they can pass it on, success fee based model, and they're able to get a commission on top of that. And the third model that we've just started in the last 1.5 years, but has scaled significantly, which has become 30% of our business now, is digital marketing, where it's not like Google and Facebook ads, but through digital channels, we're able to understand who are these merchants who probably require loan. And then we have a telecalling setup who calls from like our office in Bombay or an office in Chennai to be able to acquire these merchants. There, we have seen significant growth because one, the monitoring of efficiency in some of these cities is a lot better than like a feet on street or channel partners. The efficiency is also better, and also you know that quality of the merchants will be better because you can focus on particular categories. You can focus on certain areas that have been doing much better than others.
Okay. How do you generate this data, which is used for telecalling?
I think we've really used a lot of tools that are there as Chrome extensions, etc., to be able to figure out, like, say, pharmacy in Ghatkopar East. So then it'll give me like an entire dump of all the pharmacies in Ghatkopar East. But I know that pharmacies do really well in Bombay and that they have decent margins. So we are able to then call off all these pharmacies and be able to generate leads from there.
Okay. So it's like narrowing down on industries which have good margins and then finding
certain others actually end up putting, but primarily it's based on saying that, okay, we already have this data which we know works well. Why don't we work with that itself? And then it also went to cities where we have maybe limited presence.
Like you can see your existing cohort of borrowers and draw some trends on it that these kind of customers are coming to us for loans. So let's target more such customers.
For example, in COVID, right, it was way easier to call all the grocery shops and pharmacies because those were the businesses that are booming.
Okay. So what is the adoption? What kind of adoption do you see of the payment product by a merchant who takes a loan? Do they genuinely switch to it, or do they continue to take payments through the existing methods which they have?
I would say that 40-50% of them continue to work with us. There are others who have multiple POS machines or payment products, which we not deny. I think they can continue to work with their current payment systems as well, as long as they're able to make daily transaction enough amount that pays our EMI or EDI. That is a qualifier for us. Well, we don't deny that fact that yes, there might be somebody who is getting way lower interest rate or MDR from a bank, because bank is able to give a subvention on their MDR also because of other products that they service them, or current account exists with them. So all that we are okay with. There are certain businesses where also there might not be a daily transaction also. So there we're okay to just give a QR code and not a POS machine. For example, there could be a mattress shop. They might not daily transaction. It's not a high frequency business. So over there we can give a code and maybe not a POS machine.
Like you give POS machines through banks, and
no, we have a POS machine.
Okay. When did you launch that?
This was again around 2018.
Okay. Because you needed to have that strong control on payment inflows to collect. So it makes sense to give a POS machine. Yeah. And so for this, you charge them like the rental, which typically most.
So we have a fixed cost. We charge them one time, which is the cost of product for us, and plus a little bit of margin there. But there's no monthly rental there, because we realized from our first experience that monthly rental is where it's one hardest to collect, and then merchants end up throwing the POS machine a lot faster. But if you have it like for 18 months of a loan, and now it's free for you, then you'll continue to use it even if you're not taking a top up. But next time when you need a top up, right, we'll be the first people you'll contact us as well.
Okay, your POS machine is your physical inroad into the merchant's shop. Okay.
Because now the merchant already has a physical POS which is free, because they've already paid money for it.
And how much does the machine cost for a merchant?
It's roughly about 7,000 rupees all inclusive, which is a one-time cost.
Okay. And this is like the touchscreen kind of machine, or is it like the old school?
It has a digit system. So touchscreen is like Android based, which is far more expensive. So that would cost anywhere between 12 to 13,000 rupees. But we realized in our segment of merchants, that is not a high demand product. They wanted to be cost effective, and we're okay with that.
Okay. Got it. You said banks give you a subvention on MDR. What does that mean? Can you break that down?
What that means is, typically if I'm a MSME, right, and I have a current account with the bank. Now bank is earning interest on that by giving loans for that, but they're not giving me any interest, right? If I have 10 lakh rupees in the bank account, bank will be earning on that 10 lakh, but they're not giving me anything. So I can tell the bank that I'll remove my 10 lakh rupees from your account if you don't give me free services. So then what happens is they can give you a POS machine which does not have any MDR, maybe that doesn't have a monthly rental, things like that. Or it has a reduced MDR. Instead of 1.8%, they could charge 1.5 as well.
Okay. And how does this tie into your merchants, this MDR?
I'm just saying, not with our merchants. It's just that merchants may have existing POS machines which are given by banks, which have rates because they have subvention for the bank. So my rate will still be 1.8. But if a bank has given them a machine at 1.5, most likely the merchant will try to use that.
Okay. Got it. Okay. And what percentage of your merchants take physical POS versus what percentage take a QR code solution?
I think about 50-60% merchants take the POS, and about the remaining 40-45% end up taking the QR only as an option.
That QR would be like, say, the Bharat Pay QR where you scan with your UPI app.
UPI QR. Yeah, it is a UPI QR itself, which is accepted across all payment options. So it's a ubiquitous QR. It's just that instead of, we are able to then deduct like the loan repayment from there and then transfer the money to the bank.
So you're primarily competing with BharatPe because they also do the same thing, like targeting merchants, giving them loans, and
So there are
using
two
payment
substantial-
as a method.
I think there are two substantial differences there. One, I think BharatPe, obviously being a payments first company, right? They acquire millions of merchants for payments. And then they figure out based on that which are these merchants which are lendable. So usually what ends up happening is they might be slightly lower domain of merchants than the ones that we give. So that's why their ticket sizes could be sub 40,000 rupees, typically, maybe an average of 25,000. In our case, the average ticket size, like I said, is between 1 to 10 lakhs and average is 5.5 lakhs. So it's not always apple to apple in terms of merchants. They might do a street vendor as well. We probably won't work with the street vendor because we don't know the whereabouts on a given day.
Okay. Got it. That is the primary difference. Like they would be lending to, let's say 5-10% of their merchant base and the ticket size would be much lower.
I think this approach or strategy makes a substantial difference because to acquire that million merchants, you'll have to spend a lot of money as well. And I don't know if you get enough substantial data that I cannot gather today or I cannot check. Because if there are, say, UPI QR transactions that have happened, I can also see that in their bank accounts.
And especially with the account aggregator framework coming in.
Yes, correct. So it's not advantage in a way because the data is anyway transparent. If I use a bank, I'll be able to analyze that anyhow.
Okay. So the payment data is not such a big advantage. And acquisition cost continues to be the same for both of you.
Yeah.
You are spending only on merchants you're lending to. They are spending on a lot more merchants and converting some of them through a cross sell. But the cost of acquisition per merchant would be roughly similar.
Right. I would say much higher for them if I had to guess maybe because when you acquire a million merchants, a large portion, and we had done this and I can tell you from our personal experience, when we looked at the 50,000-60,000 merchants we had in our platform, right? Very few were actually lendable, firstly, because say a travel agent is maybe not be lendable because they are a services business. They don't have physical asset to you. Second is that when you want to give them a loan, whether they actually want a loan or not, you don't know. So either ways, like there is a conflict. So then the challenge is out of that 50,000 in every given month, if you were able to give a loan only to 50 or 60 or maybe 100, that's too low a number.
Okay, interesting. So you're like the anti-BharatPe in the merchant lending space.
So I think there are three types of players that are actually, you would have heard a lot of noise in this segment. And I think what I've seen is that there is a lot more noise than actual change on the ground. So there are three types of that we're talking about this. The one is people who are playing on surrogate data. So anybody in those sites, they're saying that, okay, we have this other data of these merchants. We want to play on this data to be able to lend these merchants. Correct? That obviously there are payments companies that are working on this as well, which want to lend as well. And the third is pure play lending companies. Now, when I talk about pure play lending companies, one of the important factors to remember is that lending globally and historically has never been a winner take all market. So unlike Amazon, it will not become the ubiquitous to e-commerce issues. Like in the lending, it doesn't exist. The second is, so these players will continue to exist. They in fact will continue to cooperate with each other to lend as well. We have a lot of partners who are our competitors also in a way, but that in the segment because nobody can fill all demands. I might work in the West and South. Somebody might just work in the North as well. Now, when we come to payment and data companies, right? Now, surrogate data companies, they've had this issue that one, their data, irrespective, is reflected somewhere or the other in the bank statements. If you're applying, if you're selling, if you're transferring money, it's visible in bank statements somehow that I can identify. And what happens is that data can also be fabricated to get a loan. And it's not meaningful enough a lot of times because if you're a distributor, for example, of goods, right, you might be 1/10 of the distributor. There could be other 9 distributors as well. When I'm assessing a merchant, I might be able to assess it on all 10 distributors and then give them a meaningful loan versus giving it the only 10th of the loan. So that's why you would see players like Khata have moved into a SaaS model and things like that. Didn't end up going into a lending model only. There is also the other side where payment companies have this thing that when they acquire a lot of merchants, there's an upfront cost to that. To bear that upfront cost, then you have a legacy issue that now I acquired these merchants. Now I need to give loans also, because I need to make sure that I'm able to justify that cost. That time you're not always the most credit conscious. Sometimes you have to break the barrier there as well. We have seen that since the time we started, there are several companies that have not given enough due importance to credit, right? That have also let go from this entire business itself. They don't exist anymore. So, like an example of Capital Float used to do a business in this space, MSME lending earlier. It's now a BNPL player. Right? I think there are a few others as well, which have gone through that cycle now. So, I think if you're not credit conscious, then there is a very high risk of being an issue.
Okay. What about BNPL companies which are targeting merchants like, say, Rupify, ePay Later, which are targeting that same category of merchants which you are targeting? Which category do they come in?
They would be lending a merchant. Typically, they're just saying that, okay, we'll help your customers like a play at paying you later. So we'll increase your revenue there. So they're not taking a punt to the merchant, but the customers who are coming to these merchants.
Okay. So, say Rupify works with Udaan and with Zomato's restaurant procurement business. Like Zomato has one vertical which helps restaurants to procure, and they give loans to restaurants or loans to merchants buying from Udaan.
But again, it's only a segment, right? So now if you buy from Udaan, you might be one of the distributors of Udaan. So you maybe have 1/10th, 1/20th, 1/5th of the business. But if you want to have the overall view of the business to be able to give a meaningful loan, that is where it becomes a difference. Otherwise, you could be in an invoice discounting, supply chain finance kind of a loan. You're giving it 30, 40,000 loan. But I won't directly call it a competition to what we're talking about. Because we are trying to give a loan which can help them from their business to a bigger scale, rather than it's an intermediate working capital loan problem only.
Your loan is like a no strings attached loan where they can use it for building another outlet, or they can use it for inventory or whatever they want to use it for.
So we have seen some of the retail shops actually transform from like a typical mom and pop store, which have all these packets lying around, to the modern retail store format as well. And suddenly they would have seen a big shot in the increase in the business, 50, 60%. Because now when customers are able to move around, right, they actually end up buying more. So those sort of changes can only happen when you're giving them a ticket size that is meaningful.
Okay. What's on the roadmap now?
So I think as we grow, we have a couple of things that we're adding on as well. So we already added insurance recently. So we're scaling that now.
Insurance? What kind of insurance?
Correct. So there are 3 products that we are currently in works with. So one is Credit Life, where you have a life insurance along with your credit product itself. So there are 2 types of life insurance. One is obviously that your loan will be repaid in case if there's an emergency. But second is that your family will get a life insurance in case if there's an emergency as well, which is a typical corporate insurance. The second is theft, fire, any accidents, etc. in the shop itself. There is an insurance for that. Third one is health. I think we've realized that post-COVID, merchants have also become equally conscious of their health and the impact it has on their business as well. So these 3 segments in insurance is something that we're playing with. We might add more later, but for now, this is the one that we're working on.
How are you making health insurance accessible? Most people get health insurance through corporate employment where it becomes affordable for them. Yeah. Are you doing some stuff to make it affordable for people who are not getting insurance through employment?
At the first step, we will work with either brokerage firms or insurance companies to be able to provide this insurance itself. The only thing is it will not become affordable, I would say, but it will become more accessible. So the roadblocks that are there in the process, because now this is a portfolio of merchants in a certain age segment, certain working conditions, certain in a city. So insurance companies are also willing to take that as a portfolio and say that, okay, we can remove some of these preconditions of tests, etc., and then give them an insurance product. If somebody individually goes, they're like, okay, first you have to take these 5 tests, and then you have to come back, and then you have to give these conditions, these many questionnaires to be able to give. I think that process is what we are streamlining right now.
Okay. Onboarding is becoming easier. If as an individual buying health insurance, you need to undergo some amount of qualifying tests and so on, which as a group, you don't need to, because companies assume that in this group, there'll be some healthy, some unhealthy. So you are able to present this as a group to companies to get them to eliminate the pre-qualifying diagnostic tests.
Oh, absolutely.
Yeah. Okay, interesting. Okay, what else on the roadmap besides insurance?
I think for now, this is what we're looking at. We have a couple of products that we look at, but that probably will be once, at least 1 or 1.5 years down the line, not right.
But
But
what
they
are
will
they?
be,
Just to understand what you're thinking.
so one could be more like a current account type product, where merchants who have excess capital can park their money in that account. So then,
and it will earn them trust.
yes, then it will earn them interest than more than what they're getting in a bank today.
And will this be through like a peer-to-peer lending model? Like that could be an interesting play here. No, like merchants who have extra money can lend to merchants who need money.
Correct. It could be through a P2P model. It could be in conjunction working with a bank also. So
Okay.
even banks don't mind working on something like this, because if you're able to give them a pool of money and guarantee that approximately around this money will always be there, and they don't mind that.
Okay. Interesting. Yeah, okay. So essentially, you're moving towards being a new bank for merchants.
Yes, it's correct. So neobanking is the case. I think what we've always kept is like, how do we help merchants as a vision? And we haven't married ourselves to the idea that we started out with, but like, how do we ensure that we're able to help them the most?
What about stuff like, say, helping them manage payroll and payouts and stuff like that?
At least in our analysis so far, that has not come out as a need, because most merchants that we work with have only maybe 1-2 people working with them. So it's not like as much of a need yet for us to help them with. So that's why we've not put that on our roadmap yet.
Okay. Got it. Okay. Is your itch for impact satisfied at ftCash?
I think
Like-
it is actually. Like financial inclusion in this space has been immense actually. The amount of changes that you're able to see, right, on merchants. I'll give you one example. One change that we've seen is back in 2019, we had gone with one of our investors on a due diligence to one of the merchants in Bombay itself, who's a small repair shop, right? It was in a very dingy corner, like nothing fancy about it, very run of the mill. But the merchant had been a payment merchant and also just taken the first loan from us. At that point, since the time, we've given the merchant 3 loans. And we've also seen the merchant over the period now having a proper established shop, having bought an apartment, now drives a car. And I think that journey of the merchant that we're able to see over the 4 or 5 year period, right? If I don't call that financial inclusion, what would be? 40% of our merchants are new to credit. 44% of our merchants are women. So that also gets players into play, don't have access to capital before.
Amazing. What is your monthly disbursement rate now? How much do you disburse?
Currently we're disbursing about 30 crores a month.
And what's your book?
About 300 crores right now, give or take.
And how much from your own NBFC?
Our own NBFC just started, so roughly about 15 to 20 crores would be the number from our NBFC.
So what is your plan? What percentage do you want on your own NBFC?
Our own NBFC will continue to be like as much as equity we can do, and like the amount of money that will be there on an NBFC, right? We'll continue to keep that. So that will always remain 20% of our overall book, but we'll continue to work with partners to be able to load further.
But why not scale that up? Because you can take debt on the books of the NBFC instead of co-lending. Because you anyway own the whole stack from acquisition to collection. Then why not just do it on
I
your
can
books?
leverage my book at maybe 4-5x of equity, wherein the same equity with a partner I can leverage up to 20x.
Okay. So you'll need to raise a lot of money if you want more on your
Yes.
own books. Then why not do that? Like, why not raise more money?
I think we get the same upside either ways.
Okay.
Like when we're raising capital also from outside in our NBFC, it'll be at the same cost. If you're working with a partner, also it'll be at the same cost.
Okay. So here it's just for vanity that you would raise money. It's not going to impact your unit economics.
Yeah, and then we'll end up diluting also.
Okay. Interesting. Very interesting. First time I've heard this. Okay. What is the value of a merchant you acquired? How much, like, what is the repeat rate and how much money do they take as loans total? Or give me some of those numbers.
I think that is a number that I might not have today because we have not been able to evaluate that enough. Because a lot of our merchants we work, they might, once they take a loan, maybe they're not eligible the second time as well. So we don't, let's say, look at as from a lifetime acquisition of a merchant itself. Because when we give them a loan the second time also, we have to do a complete evaluation.
Okay.
But a business moment.
Currently, what is your number of people who've taken a second loan?
This would be about 50% of our existing merchants do take a loan second time.
50%. 30%. Okay.
50%.
So you've raised close to $15 million so far.
Yes.
Total.
Yes.
And what are your lessons on fundraise?
So we've always had interesting journeys in fundraise. So when we just started out, I think this was right around 2015-16 when the frenzy of fundraise in 2014-15 was just ending. So at that time also, like, raising money was a bit of a challenge because there was almost a funding winter at the time as well. Easy money was gone and we were heading into a business where we had to show profitability, path to profitability, unit economics to be able to raise money. So I think it's not that we got an easy money at the time as well, but whatever little we did, we tried to work with that for the longest time. In fact, before our Series A fundraise, I think we got into a point where we'd almost run out of money and we had no money to pay salaries or vendors, etc. And it just so happened that we had gone to MIT in 2019, November 2018, and we won an award by them for the most innovative fintech in the world. And they gave us $250,000. That allowed at the time to survive for the next 3 months. We actually got them. But we still don't know what we would have done without that. So those have been the times. There have been times like, obviously, we suddenly have to calibrate ourselves in terms of making sure that we stem our growth a little bit, just in case, like, to make sure that our runway is elongated. So I think that is an ongoing journey that every founder has to go through.
And that brings us to the end of this conversation. I want to ask you for a favor now. Did you like listening to this show? I'd love to hear your feedback about it. Do you have your own startup ideas? I'd love to hear them. Do you have questions for any of the guests that you heard about in this show? I'd love to get your questions and pass them on to the guests. Write to me at ad@thepodium.in. That's ad@thepodium.in.